We're going to continue our discussion of financial strategy by talking about the asset management path. When we talk about the asset management path, all of the information that we need to analyze this path can be found on the retailer's balance sheet. So let's talk about the balance sheet for a second. The balance sheet summarizes a retailer's financial position at a given point in time, and this typically is the end of the fiscal year. When we talk about asset management, what we're doing is we're assessing the productivity of the firm's investment in its assets, and that indicates how many sales dollars are generated by each dollar of assets. So when we talk about the balance sheet, we're looking at those assets. And when we look at those assets, we first have to break them down. If we're gonna do a recap back to your finance class here, into current assets and fixed assets. So when we talk about the current assets, these are assets that can be converted to cash within a year. So they're items that we can easily convert to cash. And so four items make up current assets. And the first is cash itself. Cash that the company, the retailer, has on hand. And the second is accounts receivable, or money owed to that retailer. So a lot of times, especially in retail, items are done on charge. So the customer charges items on either their credit card or the retailer's credit card. That retailer is going to collect that money usually in 30 days or 60 days or 90 days, depending on credit card terms or credit terms in general. The third category is merchandise inventory. Now, this is very specific to a retailer. Merchandise inventory is the goods that the retailer invests in and currently holds in stock. So our merchandise inventory is really what enables the customer to find what they need in the right place at the right time. So it's what they have, what the retailer has in stock, either in the store. This also includes anything in their warehouse or possibly at distribution centers if they're a large retailer. So this is the inventory we have in stock. And then oftentimes on any given balance sheet, you'll find in other current assets. And so that makes up a whole bunch of different items. And so that would also kind of roll into our current asset calculation. So let's talk about our fixed assets. Now, our fixed assets are assets that require more than a year to convert to cash. So in a retail establishment, those assets include items like the building. If we own the building, if we're not leasing the building, if we own it, it's a fixed asset for us. It could also include distribution centers if we own those distribution centers. Our store fixtures would fall into this category, and we'll talk about fixtures specifically when we get to our presentation section of the text. But any shelving, any racks, any stands, those would all be a fixed asset. Our delivery trucks would be a fixed asset. Our computer system, our information systems, all of those are fixed assets. We can't quickly convert them into cash. So let's talk about the balance sheet, and we're going to go back to our Costco and Macy's example again. So you'll see this in your book, and it's also here on the screen. But let's talk about some of the measures that we need to calculate our path along asset management. Okay, so this is, again, a snippet from what's in your book showing all of Costco and Macy's numbers. It's got their current assets on there, their fixed assets, and it brings in net sales from the income statement, which we'll also need, but it kind of does all the math right there for you along the way. I do recommend that you go back and practice some of this math. You'll need it for assignment 3 and also for exam 2 and also for your partner projects. So in this case, your text has done a lot of the math for us to help speed up the lecture, but it will be beneficial for you to practice looking at financial statements and calculating current assets, calculating fixed assets, calculating the total current assets number, which is really just that addition right there that you see. But it would be beneficial to practice some of that. So let's talk about some of these ratios that we look at when we're doing these measurements. So we walked through 3 measurements when we talked about the strategic profit management path, and now we're going to look at a few ratios for our asset management path. The first ratio that we really need to look at is our inventory turnover. Now, our inventory turnover, what that measures is how effectively a retailer is using the investment in their inventory. So inventories cycle through the store during a specific time period, and we're going to look at it over the course of a full year. Some retailers measure their inventory turnover quarterly, some of them measure it seasonally, and some of them keep track of it daily, weekly, monthly. But we're going to look at inventory turnover over the course of a year. So how many times a year are we moving inventory through our retail establishment? So to do that, we need to look at our cost of goods sold over our inventory. And so we have to go back to our income statement to pull our cost of goods sold number. Okay? And then we're going to take that over our inventory, or as it's worded here, merchandise inventory. And that's going to give us our inventory turnover number. So let's calculate Costco and Macy's. All right, so if you've looked at your balance sheet and you're writing down numbers, we're looking at our inventory turnover, right? Let's look at Costco. We're going to take our 86,823 number. Okay, that's our cost of goods sold. And our inventory number is our 6,638. And so our inventory turnover is 13. Costco turns over their inventory on average 13 times a year. Now let's look at Macy's. Let's take our cost of goods sold, which is 15,738, and let's divide that by our inventory, which is 5,117, and we get 3. On average, Macy's turns over their inventory 3 times a year. Why is Costco so much higher than Macy's in an inventory turnover analysis? Costco is a warehouse club. Costco sells commodity items and they sell food items. Therefore, customers are buying those items on a weekly, maybe a daily basis. And so inventory is turning over very quickly. When we look at Macy's, they're a department store and they sell apparel and household goods. People aren't shopping for apparel and household goods on a daily or weekly and sometimes even a monthly basis. How many times does the average customer purchase clothing versus cereal? Right, so if you think about that, we can expect inventory turnover to be much lower at a department store, possibly a specialty store, because consumers aren't buying these on a regular basis. They take a lot longer to sell. Let's look at asset turnover. This is the second ratio that we're going to use to guide us through the asset management path. When we look at asset turnover, we look at net sales over our total assets. So we pull in our net sales from our income statement, and we're going to get our total assets from our balance sheet. So we're going to add up our accounts receivable, our merchandise inventory, our cash, our other current assets, and our fixed assets, and we're going to get our total assets number. So let's look at Costco. And if we pull our net sales number of $97,062, and we divide that by our total assets of $26,761, we're going to get 3.63. Okay. Now let's look at Macy's. We're going to take our net sales of $26,405. We're going to divide that by our assets of $22,095, and we're going to get an asset turnover of 1.19. Asset turnover measures the performance of our asset management. Costco turns over assets much faster than Macy's. This makes it a little bit easier for them to forecast more accurately. It makes it easier for them to control inventory levels because they're able to see on a more regular basis what they're doing, what they're turning over. So these are the two ratios that we look at when we're measuring the asset management path. All right, so here's the balance sheet again. Now let's talk about the combination of these two paths because that's really what we need. Okay. When we looked at our asset management path, when we looked at asset turnover, we could see that Costco was outperforming Macy's 3.63 to 1.19. But when we start to combine the asset management path and the profit management path, when we merge them together, we take our operating profit margin and our asset turnover to get our return on assets. And so if you do that math, for Costco, our operating profit margin percentage, if you go back through your notes, was 2.9%. And we're going to multiply that by our asset turnover of 3.63. And that gives us 10.5%. Now let's calculate Macy's. If you go back through your notes, their operating profit margin percentage was 9.0%. We multiply that by their asset turnover of 1.19%, and we get 10.8%. What does that tell us about these two retailers? Which one is performing better? They're both performing about the same, right? So when we looked at our profit management path, Macy's clearly was outperforming Costco. And in that analysis, we would have selected Macy's as the best performing retailer. When we looked at the asset management path, Costco was clearly outperforming Macy's. And so given that analysis, we would have selected them as the best performing retailer. But when we look at the most important measurement for retailers, return on assets, we can see that these retailers are performing about the same. They're both performing well. And so retailers and investors have to consider both the profit margin path and the asset management path when evaluating financial performance. Because we want to look at, when we are measuring different types of retailers, a wholesale club to a department store, it's very difficult to look at one of these measures or one of these paths. But when we look at them together, it balances the board. And so we have an even playing field to measure retailers against each other, even if they have different strategic decisions made on their overall strategy. Right? Some retailers choose to focus on profit margin. Some retailers choose to focus on their assets. This puts them on the same playing field. Supermarkets and discount stores are going to have higher asset turnover. And that's because consumers are shopping for products daily or weekly. They're shopping more often. They're turning over their inventory and their assets more often. And they're going to have lower operating profit margin percentages because they have to keep prices low in order to stay competitive. So their margins are much lower. Category specialists and department stores are going to have lower asset turnover, right? Their assets and their inventory aren't moving as fast because customers don't shop as often. But they're going to have much higher net profit margin percentages because they can charge higher price for what they're selling. They offer services such as customer service, or they have fitting rooms to try products on, or they compete based on the atmosphere of their store, and all of those things cost a bit more money, but they're able to charge their customers a higher price in order to achieve a higher margin. So all of these differences really look back to the type of merchandise that the retailer carries and the type of shopper that they target. And that's how they choose. That's how a retailer chooses, based on their strategic, their overall retail strategy, which path of the strategic profit model they want to focus on. So how does 10.5% compare amongst other retailers? Well, this chart's in your book, and it's kind of fun to look at as well. And these numbers actually all they're a few years old, so if we're looking back to a few years ago as far as where the ROA fell. But you can see kind of compared to different department stores and discount stores, where they fit in. You can look and see kind of how it all works, and it breaks it out for you into their operating profit margin percentage and their asset turnover. So it's just kind of fun to see in general where retailers fall.